I invest in a variety of different companies. Consumer is a part of it, but I also spend a lot of time looking at marketplaces, fintech, healthcare, supply chain and logistics, vertical SaaS. It's pretty broad. So hopefully have some, touched enough different areas that I can be helpful to you guys regardless of what you guys are working on. But, I think Chris and I decided to keep this casual. If you guys have any questions or, anywhere I can kind of help or jump in, just let me know, and happy to be helpful in any way that I can.
Yeah, awesome. Thank you. I guess I'll sort of get the ball rolling here. There's sort of an interesting shift into fintech-enabled marketplaces and sort of using like payment infrastructure and kind of like that whole tide to like piece together a marketplace. I was sort of, I guess I've sort of been reading more and more about like that intersection between like fintech marketplaces and like SaaS type products. And I'm curious to know, do you have any advice on like where to get started with that? Would you usually take on like SaaS first or marketplace or the fintech side? Like where do you get started?
Yeah, it's a great question. And maybe one request I have for everyone is, and maybe Marwan, you can start, just if you don't mind giving me a couple sentences on your background, and if relevant, if you're working on something or iterating on something, just give me a little bit of context on that. That would be super helpful.
Yeah, so basically what we're working on is a modular banking platform. And the concept behind it is onboarding people and building them a custom banking app based on their needs. So basically the flow is you get on a sort of consultative call with a financial coach or advisor, and they mix and match different modules to create a customized app that meets whatever needs you may have. And so in some ways, this is a fintech-enabled marketplace, given that there's the modules, which would be externalized providers, and then the like user side marketplace being connected to them. And in some capacities, it also would be acting as a SaaS tool for the businesses providing the modules. And so our challenge now is that it's a pretty big undertaking, and we sort of need some guidance into which aspect of the challenge to tackle first.
Okay, and are you a current undergrad?
Not anymore, but okay. Formerly, yeah.
Awesome. And just so I understand, the modules are what type of modules? Are they primarily like payments or financial services?
So it's mainly like super front-facing UI modules. So if we think about like Plaid as building all the like pipes to connect different financial services, we're sort of building the skins to all of these different services and really focusing on like the hyper front end side of the experience.
But touching like financial workflows, finance related workflows specifically, or
yeah, so mainly like personal financial management, so like consumer facing app.
Yep. Okay, super helpful. So I have a bunch of thoughts on this. My first is I wish we had done this or connected like a week and a half ago. So I believe pretty strongly that the future of fintech or financial services is going to move from being kind of standalone apps and specialized I feel like 1.0 was kind of monolithic institutions, like a First Republic that offers like all the different solutions you would need to one customer. And over time that's gotten fragmented, right? Robinhood does mostly public market investing. There's a bunch of neobanks. There's a lot of service. Wealthfront does kind of more passive management, and it's gotten broken out to these digital players. I think the wave after that, in my opinion, is that financial services becomes embedded in marketplaces or marketplaces, because I think it's a very natural extension of what these companies are doing already. by adding financial services or finance tool like fintech tools. They're just enabling further workflows for their customers and increasing LTV. Plus, they have so much data to make those decisions on their folks that kind of like a net new customer would have a lot more friction to build. Like the best examples of that are Shopify and Square. Like they're doing an amazing job of that. And so I actually hosted an event with the head of Shopify Capital, so the person who's kind of launched all of these products at Shopify like a week and a half ago, about kind of his learnings from Shopify and best practices and advice he has for founders who are thinking about embedding financial services into their companies over time. So I appreciate you asking that question because it's very front and center to me, not for me, not because I think it's just because I think it's a feature, but we're also seeing it in our portfolio companies. I think what I would say is like a lot of these financial services, because of that thesis and the point of view I'm coming at it with, is I think the natural progression is to add these financial services products over time. I think like I wouldn't start with it. I wouldn't start the intellectual exercise of saying, do I want to start with a marketplace or SaaS or fit financial services? Like I would start with the question of like, where is the biggest pain point for my customers? And therefore, like, what is going to be that tool that's going to be the wedge in for them where I can gain adoption and then add, and you're already building a modular product, it sounds like, where I can add more modules over time that just like make sense once they kind of take my first product and it's a wedge. Like in Shopify's example, if you're already running your business on Shopify, taking payments, you know, Shopify didn't start with payments. That was like a long project where they partnered with Stripe. Like payments was the next, for Shopify's customers, in their mind, the next obvious step, right? And then they kind of kept looking at like, what are the bigger and next big pain points that are hindering growth for their customers and therefore for Shopify, where you could kind of add growth vectors. And that's how they arrived at those, at the kind of products they wanted to add. And so I would start with that, because I think if you try and intellectually engineer an answer of like pro-con list, like, you know, 2x2 matrix, I think you kind of end up with an intellectual product versus one that, and there, you should totally do that. I think there's a place for that, but I would start with kind of like the customer pain point.
Do you mind if I ask a quick follow-on question to that?
Totally, yeah.
So I guess the biggest pain point we've identified that's like relatively low-hanging fruit is tackling the onboarding process first. And by that, I mean like the actual service side, like operations of things. So sort of with Superhuman, if you're familiar with their onboarding process, having that like human guided onboarding and training like an internal team to basically like creating that role of like financial product builder type, like integrator, architect, whatever you want to call it, type role. But the main challenge with that is us trying to find out how we decide whether it's better to like fully insource that function, or do we want to build the like onboarding process as a marketplace where we're externalizing that. And the conflict is that we're seeing like the current version of most marketplaces being like Uberized models, externalizing a lot of services, but then we're seeing like fully insourced marketplaces like Open Door and things like that. But it's very capital intensive to do that. So do you have any like, I guess, advice or ways to think through that problem?
Yeah, I'm not sure if I understand your question correctly. I might not have, but so correct me if I'm wrong. But if there are people that are doing what you're trying, the features that you want to add into your product, if there are companies solely dedicated to that and doing it really, really well, I kind of bias to why build it yourself. Like figure out what your core competency is and be better at everybody else at doing that, and then integrate with people or be customers of people that are already doing something else that's really great, right? Versus if you don't think there's anything great in the market, then being more full stack and managing it yourself might make the most sense. Does that if your question was what I thought it was?
I think I didn't phrase it super clearly. I guess it's the challenge is a service like Plaid, for example, is targeted towards a technical user, and so they have the skill set to be able to like integrate that into their ecosystem. But since we're trying to build a very consumer centric, like sort of B2C or sorry, like direct to consumer like product, there needs to be somebody that like onboards them or like configures the app or configures the product. Oh, sorry, I think you muted.
Got it. You're saying like who's doing the integration?
Yeah, exactly.
I think that if you, for your first couple of customers, if you think they have the opportunity to be large LTV customers, you should help with that. I think over time, you want to get away from that because, you know, this is without knowing anything about your business and where you're going or what you want to do. But I think over time, you want to not do, you don't want a majority of your business to be services based. And if your customers don't have the capability to do an API integration on their own, they're probably, I would imagine if you're building a technology first, like front end layer that's modular, they're probably not going to be the right customers for you long term, is my hypothesis. So, and that relates to another point. I think like as an early stage company, the impulse is to like accept any customers or potential customers that could have interest. I think it's really hard to say no or to fire customers, but it's maybe one of the most important things that you can do is to stay hyper-focused as an early stage company. Like your biggest constraint is capital and time. And so if you say yes, I think many companies run the risk of saying yes to too many people and doing too many things and then losing sight of what they are hyper good at and what they want to build. And they run out of time and resources to do those things. And so it's extremely difficult to do. If someone says like, hey, I'll pay you $100,000 to do this thing for me, it's a little bit different from what you plan to do. And I don't know that you can do it for anybody else, but like we could really use it and we'll give you $100K. It's pretty hard to say no to that, but I would urge you to be like ruthless in prioritizing what is going to be your core competency and what's not going to be.
That's great advice. Thank you for that.
Sort of continuing on this trend of consumer fintech, I suppose. I'm Roger.
Do you mind introducing yourself first? Yeah, perfect.
I'm Roger. I'm the co-founder of Finery. Finery is an investing discussion site where millennials can interact with other investors. They can join forums on a wide range of investing topics, and then they can also make trades. So simply put, imagine Reddit combined with Robinhood, or in other words, a verticalized community for investors. So I'm kind of curious about how you assess early stage companies, and that do you compare them to other similar early stage startups doing the same thing or similar things, or do you compare them to incumbents, the big players?
In terms of whether to invest?
Yeah.
That's a good question. I would say it's like a little bit of both and maybe neither at the same time. It kind of depends on the space. So I'll say I love that space. Like the FinTwit world, I call it kind of like the FinTwit world is like a crazy world that is not productized and very somewhere on Reddit and somewhere on Twitter and like
right. There's
so much false information and it's kind of crazy. So I love that category and I'm excited to hear that you're working on it. So how we make a decision depends, it's not going to be a very fulfilling answer, depends on what else is in the market and where the company is, right? Like if there are a lot of early stage companies in the space, then, or other companies in the space, part of our job is to evaluate where on the competitive set you are, right? It doesn't really matter if they're early stage companies or large established players. The definition of a large established player is kind of like in the eyes of the beholder, right? Some people would call like Shopify an emerging company because they're still growing so fast and there's still so much runway. And someone else would call them a like established player, right? It kind of depends on who you're talking to. And so I think our job is to evaluate, hey, is there opportunity in the market for this? Is there a customer need? And is this the right approach? Do we believe this is the winning approach and the right team to do it? Those are the, and then the fifth question I'd add is like, is now the right time? Like, why hasn't this existed before? And if we can answer all of those things or get comfort around answering those things in the future, then we get excited. And so I think, I hope that answers your question, but it's kind of like in the context of answering those questions, our job is to evaluate all of those things.
Right.
Hello, I'm London. I'm a senior at the college. I have a question for you about how to categorize a new business. So I'm working on a business whose goal it is to raise the level of technology that first responders use. And we're doing this in two ways. One is by providing a clear pipeline for people who create technology to go from an idea to a full product. So we're providing testing services for technology creators. So if you have an idea and you have a mock prototype or whatnot, we can test it, give you feedback from first responders and help you build it out into a real product. And then on the first responder side, we're talking to first responders and doing more consulting to help them find tools that they want. So basically trying to aggregate tools among the first responder community and help them communicate. And I'm curious as to where you would see this falling in like the categories of startups, or how I would be best off marketing this to startups as like, this is in this field, which you should be interested in because.
What is the business model, if you don't mind me asking, London?
So the business model is basically like a two-sided market. On the one side, we charge the technology creators to both test their technology, and then we also provide marketing services for their technology. And then on the first responder side, we're more of a consultancy. So you pay for our consulting services in order to help you find the best technology for your first responder team.
Got it. So it's marketing plus consulting?
Yeah, I think so.
Then I think you kind of have your answer, right?
Yeah. Yeah. Is there any way to fit in the like testing services? Or should I just say it's like marketing and consulting if that's what it is closer to like where the sale is actually being made of the products?
Well, it sounds like you're doing the full suite of go-to-market help, right?
Yes.
Go-to-market is like crafting a strategy, marketing it, selling it, closing it, implementing it. That's like the life cycle of go-to-market.
Okay.
And so it sounds like you're doing a little bit of all of that.
Mm-hmm.
And so, I wonder if that's one way.
Yeah.
To market it.
I like that. Okay. Go to market. All right. Helpful. Thank you.
Two sides, to be extremely simplistic, there's two sides of a company to get it to work, right? There's the product and edge side, and then there's the go-to-market.
Yep.
And unless you're like going to do complete product-driven growth, which is very hard to do, and there's very few companies that are examples of doing that really well, you need to be very good at both of them. And it sounds like you're helping on the latter.
Yes. Yes. Thank you.
Yeah.
Hi, my name's Jordan Topoleski. I'm a rising junior in Lowell House, and I'm working with Marwan on Alloy. I've been really interested the past few months at customer acquisition costs, especially in Fintech, and using that as a sort of leading metric in guiding your initial product. I'm very curious to hear, especially with sort of like the credit card craze we're in the middle of and so many neobanks coming up, if you have different strategies on differentiating yourself in the Fintech space to sort of drive down that CAC.
Yeah, it's a really good question. I think it depends on if you're offering a B2C product and service or a B2B one. I think the answers are different. You're thinking about more the B2C, like a consumer focused product.
Yeah, I'd actually be curious to hear both answers though, if you wouldn't mind sharing. Like B2C and B2B.
Yeah, I think they're just different animals, right? Like the different ways that you can, on the consumer side, is you can either sell directly to market directly to consumers and get them to sign up, or you can do it via like channel partnerships, right? Like get sign on to like what's a good example of that, right? Like Chase will sell a bunch of other smaller companies products as part of their credit card offering, and then that's a way for those companies to do lead gen, right? Is they're basically subsuming their customer acquisition cost into like the offer that they're giving to Chase and to the consumer. It's like 1 year free, or 2 free transactions or whatever. And so it's just another version of marketing and acquisition. I think it comes down to your product, to be honest with you, like, and then it comes to your marketing. I think if your product is the same as a lot of other people's, you're going to have the same marketing and the same challenges as everybody else. And so you just have to anticipate that your customer acquisition costs are really going to be quite high, and your conversion will be lower, right? Because you'll have to kind of blanket more, and then the conversion will be lower because there's more. So per click or per impression, it'll be higher, and then your conversion should potentially be lower because there's more competition. You just have to assume that your customer acquisition is going to be higher, and then you have to build a business model around that high customer acquisition cost, which means you have to build a business that you anticipate relatively high contribution margin and LTV over time, and such that you can sustain you get to a payback period that's sustainable for a business without having to raise crazy amounts of money and be dilutive, right? Does that make sense?
Yeah, totally. I appreciate that.
Whereas if you have like a completely differentiated product, Robinhood's an example, right? Like fractional ownership of shares was a completely novel concept, and zero trading fees was completely novel. And so by virtue of the fact the product was completely unique, it kind of marketed it itself. And they kind of put their acquisition costs into the product by offering like whatever it was, like $10, like $10 free or whatever. And so they allowed the product to speak for itself. On the enterprise side, I just think there are more options. Like you could do direct sales, you could do product driven, like a freemium model, you can do channel sales. There's so many different ways that you could think about building your business and tiering it. And I think it's figuring out like who is your similar consumer, but I think even more important is like who's your target persona? How are we hyper focused on exactly who our user is? And how do we target that person versus kind of like churning the ocean of all the potential industries and segments and size of customer that could make sense. I think that's when customer acquisition is inefficient and starts to get really expensive, because it's expensive to acquire a lead and get someone in the funnel, and then it's a leaky bucket, so the number of people that you convert is so low that the customer acquisition, it feels very difficult to have positive economics.
Makes sense.
I had a question. So hi, I'm Roman. I'm a first year living in Quincy House. And Aiden is kind of the co-founder of this project. He's also here. And we've been working recently on building out a two-sided marketplace for small batch specialty sauces. And kind of we were starting off with like hot sauce because there's such a kind of vibrant niche community there, but the idea is to expand beyond that. And the problem that we've been facing in kind of the short term is we think that at scale, explaining the value prop is pretty straightforward just because of the, data collection and being able to tailor sauces to specific, dishes and really powerful search engine and stuff like that. But in the short term, it's really hard to explain to producers as we're trying to onboard them, like what the value of the marketplace is. And especially kind of the problem of being disintermediated. So them kind of wanting to just funnel that to their own website if they have one, or to some kind of other distribution channel. So is that just kind of an inherent problem with these good marketplaces, or do you think that there's a way around that?
Yeah, it's a really good question. And I was in Quincy, so love that. I would say that is a problem with almost all marketplaces that are transactional that are not transactional in nature generally, right? Like, so if I look at a spectrum of like subscription, like repeat business and one-time transaction, and then like commodity service to, or product to like, you know, very differentiated. A product that is repeated, where the person who is doing it or the product differentiation is important, is at the highest risk of disintermediation, right? Like, so Handy is a Harvard company. That's a great example. Like, you get your house, if you're getting your house cleaned, you're getting it cleaned on a very regular cadence. And the person that cleans it, you know, maybe at first blush, you're like, oh, whoever cleans the house, it doesn't matter. But people have like they want to know who's in their house, and there's a range of like quality. And so when people find someone who is good, they like to stick with them. And so that's like an example of where highest churn happens in terms of things going off platform. On the other side, you have something that's like highly transactional, that's not, you know, a standard like repeat, and it does not matter. It's very commodity, so you don't care who it is. Uber is the perfect example, right? I think there are some people that need to get from point A to point B on a regular basis at the same time and place. I would say 99% of people that use Uber are not consistent on when, where they're going, and like how frequently they're using it. The most important thing is how quickly that car will show up. And they just want to go from point A to point B. And so there's some discrimination of like, do you want an XL or do you want a Lux car? But like, at the end of the day, people don't really care. As long as the car gets from point A to point B in a safe way, it doesn't matter who it is, right? And so I would venture to say there's like almost no disintermediation on the Uber platform. And so those are the two like the extremes of the spectrum. Does that make sense?
Yeah, yeah, that part made sense. Yeah.
And then the second part of it is, if you're seeing disintermediation, I think the question you should always ask yourself, or I push my companies to ask, is what can I be doing to add value to one or both sides of the business, such that the incentive to go off platform goes away, right? Either because of that specific transaction or because of the entire relationship. So Airbnb is a great example. It's like highly transactional and like one-off, right? At commodity and like not repeatable, right? If I'm going to Santa Barbara and I want an Airbnb for 6 people, the likelihood that I'm going back to Santa Barbara for an Airbnb with 6 people ever again is extremely low. So I should, like, it should be, you know, whether like I just care about getting the best price. The reason that most hosts will not go off platform now, Airbnb had a huge problem of people going off that platform. So they started adding other services over time. So why do hosts not want to go off platform? Insurance. Airbnb provides insurance for damage or any other issues that they otherwise wouldn't have for rental or guests, because it's not a rental property, right? It's just their house. And so they need insurance for that. And they don't want to take on the risk that I'm like a crazy person that throws a party and trashes their house. And, you know, now they're stuck with like thousands of dollars in bills that they have to take on. So they want to stay on the Airbnb platform. Same thing with consumers. Like, you know, as a consumer, all kinds of things can go wrong if the host is not true or not verified, or they scam me, or I show up and I like can't get in, or it's not what I thought it was. Like, if I try and get my money back from the host, I have because it's highly transactional, very low chance of that happening. If I go through Airbnb, they've created a policy where maybe I believe that like at least I have some security. And then another thing they've done is payment, right? In this specific example, before Airbnb or VRBO, you were like giving someone a check. Like, how would you do a deposit, right? Like, would you send them an ACH payment? Like, Venmo wasn't a big thing until relatively recently. So like, how are you going to pay them? If someone wants a part deposit and then they want some on arrival and the person's not there, like how do you manage that if you're in two different places? So going back to that fintech and financial services embedded into these platforms, that's another way. And so there was value in that and people are willing to pay for that. So those are like a couple examples. Airbnb is like one example and a couple, things that they're doing that shows what they've done to try and reduce the disintermediation. And I would push you to say, you and Aiden to say, hey, what are those types of things that we can add and the services and products such that either the consumer or the seller or both, the buyer and seller both ideally, are disincentivized from going off platform because of the value that you're adding.
Thank you so much. That was really helpful.
I'm actually going to jump in with, I think, a more general question that kind of plays to what all the previous founders have asked, but do you have any advice about how founders should be validating, their product market fit? And, what do you do if maybe you've noticed that it's not as popular or gained as much traction as you thought it would? Like, do you pivot or do you really just try to continue down this path and maybe try a different time? Maybe some like general advice for everyone here.
Yeah, it's a really good question and a really difficult one to answer. I don't think that there's a right answer or wrong answer. I think there are certain industries where kind of like the trope of moving fast and breaking things doesn't work. Like highly regulated industries, like probably a bad idea, just to like throw stuff out there without regard for like all the laws and the rules, expectations are different. But I think if you're building a traditional consumer or enterprise tech company, within reason, I'm a pretty strong believer within reason. I don't think you want to release like a truly terrible product, but I think getting your product in front of customers as early as you can is really important, because I think the mistake a lot of founders make is they're like, in my mind's, I've talked to a lot of users, I now hear what they want, and in my mind's eye, I know what they want, and I'm going to build that thing. And then when it's ready, like it's totally ready, that's when I'm going to show it to them. And so you can go into your hole and your cave and build for a quarter or 2 quarters or a year, and then come out and show it to someone. And maybe, you were so deep, you kind of like went in a direction that didn't end up jiving with who your user was. Or maybe you talked to a subset of users that weren't representative of a larger sample. And so I think just getting potential users in front of your product to give you feedback and using it as early as possible will help you iterate faster. And just knowing, like being done is better than being perfect. I think like that couldn't be more true in tech to kind of get to that. Because again, like the biggest constraint is money and time. I think there are a lot of companies, we say this internally, like there are a lot of companies that if they had more time, they had more money and therefore more time to run their company, they would have been successful and they would have figured it out. But in an environment where those things aren't endless, in the time and with the money that you're allotted, you kind of have to get to a point where you have enough conviction, and people who are going to, if you choose to go down the funding route, people who are going to fund you have the conviction to give you more money and therefore more time to hit the next milestone. So I think that gets to the first part of your question. The second part of your question of like when to throw in the towel, I think that's a really personal decision for people. Like, I think if you really believe that there's something there and you just want to keep iterating and finding it, then I think that's totally the right choice. The only thing that I would say is like, I think for some people kind of feel like either they don't want to work on this problem anymore, or maybe it's not what they thought, but they feel a sense of obligation either to their team, their co-founder, or their investors, that, hey, I took your money and I promised you I'd come up with something and I haven't. And I, as an investor, my argument is like, I will be fine. Like the expectation is we're early stage investors that a lot of our companies will not work. I think the worst outcome is that you're working on something that you're not happy doing. I think the success comes from working on something you're passionate about. And so I think just accepting that, like, we're all overachievers. Like we all got to where we are because we like to do everything like 110%. There's a high failure rate in tech and in startups. Like the failure rate is extremely high. I don't think that's a bad thing. Like, I worked on 2 companies that aren't huge successes. It sucked and it was really hard, but I would posit to say I learned as much, if not more, than if I were at like a company that was always growing fast and didn't have that many problems. So, you know, I think there's a lot of value in the failure as well, if you want to call it a failure, but I think it's the learning.
Very general question here, but I'm curious to hear your thoughts on investing in college founders. I've heard different opinions, but let's say a freshman with a really great company comes to you and you want to invest. Is that something you would do, or would you potentially ask them to drop out?
I would never ask. I think this is a very personal question, investor to investor. I personally would never ask someone to drop out of school if I were investing. Because I think the most important thing goes back to like what my core tenet is, which is like what's best for that person, not what's best for me. I think doing what's best for that person will yield the best results for them and therefore for me. And I think if someone wants to work on something while they're in school and they want to get their degree, then, you know, that degree is going to stay with them longer than the company potentially. Like dropping out was the right call for Mark Zuckerberg, and I'm super glad that he did that because now we have some amazing products thanks to him. But for a lot of people, it's also not the right answer, or they don't feel like it or can't for a variety of reasons, and that's totally okay too. I think the first part of your question about like investing in college students, like I think it's awesome. Like the part of, I think to be an entrepreneur, you kind of have to be like blissfully ignorant on how hard it is to start certain companies, right? Like if you asked the founder of Coupa, which is like a payment management platform, like expense management platform, or you ask the founders of Robinhood, or you ask the founders of Flexport, like they would all tell you if they knew what they know now, they wouldn't have started those companies because it's so hard. And so many people and founders, I mean, investors told them like, here are all these companies that have tried it and not worked, and like, this is not going to work, and here are all the reasons why. And they were kind of like blissfully ignorant about those and like dogmatic enough to like figure it out, and have yielded huge companies. And so, you know, I think like I was most like that when I was in college. And like, you know, the real world and kind of like working has kind of like eroded that over time. So I think it's a really exciting time. I think the other side of it is like, you don't have a ton of experience in like business or in tech. And so it's just about finding those people that have that raw desire and drive and passion, and, you know, surrounding them with people that can help them build the functions that they need to be a big company.
So I guess you would say that there is an outcome in which VCs or you yourself personally would fund current undergraduates or college students who are working on a venture.
Totally, yeah. I think like Harvard doesn't feel too great about that, if I remember correctly. So I think there's like that to navigate. I think it's probably easiest when someone's like either decided that they're going to drop out and work on it full time, or if they're seniors. Mm. I think just with the college, it's more complicated. But you know, intellectually, I don't think that there's like anything wrong with it.
Thanks.
It's a broad question. It's not really anything specific, but you mentioned in like the beginning that you're into marketplaces and fintech, and just from the stuff I've been reading, I know a lot of people have kind of big picture takes on what marketplaces like 3.0 look like. And I was just kind of wondering if you had a particular thesis on where that industry is going and like the types of spaces that you're really interested in.
Yeah, it is a really good question. I think that a lot of the marketplaces that were built today or that are being built today are not obvious. I think that if you go through the GDP and largest areas of spend, a lot of the obvious ones have been picked off. And I think the most interesting ones now are people where people have a differentiated view on either what the market should be or like what the business model should be and the offering should be. I also think an area that's not talked about that much, but where there's a lot of potential is B2B marketplaces. We're seeing a ton of innovation there. Like a lot of industries are just, it's crazy where they are technology adoption wise and what they're doing. And so, I invest in a company that started as a B2B marketplace for supply chain professionals. And they were connecting like suppliers, so like factories in China and the US and Europe and stuff, to brands who are looking to like launch products. So like Harry's and Lola and Hims, a portfolio company of ours, were customers of Anvil, the company I'm talking about. And prior to this, like companies Googled and went to China and just kind of like walked the streets and like talked to brokers, and like it was crazy what they had to do to talk to their friends to see who was using who, and like it's crazy what they had to do. And what Anvil was starting to do is like build a marketplace where as a brand you put in everything you want and then you get a bunch of quotes back and you can decide which partner makes the most sense for you, right? Like as a tech person, that seems pretty basic to me, but that's revolutionary in the industry. But that would have never occurred to me. I'm not, super deep in supply chain. The founder's done supply chain his entire life, so he's the perfect person to build this. But that's an example of one, I couldn't have predicted that if you asked me that, 5 years ago. I wouldn't have been on my top 100 list if you asked me to brainstorm, but it's a really great business and they're adding tons of value to for their customers.
This question might be a little bit more on the petty side, but I was looking at the Redpoint portfolio, and there's quite a few companies there that are like sort of one-word domains or brands, notably like Stripe or Snowflake or Hims and Root. And when you're trying to build the brand of a startup in the early days, especially if it's like a consumer product, it feels like there's this overwhelming sort of paralyzing emphasis on like, you want to get all your domains in order. You want to be able to like have a brandable name and all that type of stuff. But so to cut to the question, how does a Robinhood sort of like push through with that name and then like retroactively cop all those domains, like secure that like really tough branding, or like Stripe, which I know started as like /dev/payments as the initial name. Like, how is it that companies like pull off that very aggressive branding shift? And how important is it that you have like the correct brand from the get-go?
I think it depends on the company. Like Hims is a consumer company, and a lot of what they were doing was innovative around the business model, but also customer acquisition. Like they pioneered sharing on social, something that no one ever talked about, even with their friends, right? To share that where they started was when we invested, they were targeting men who were either had hair loss or were worried about hair loss or had ED and were getting treated for that. To share, their primary channel was marketing it, and then people were sharing, right? Like it became cool to use Hims and to share it and like share photos of using all of their products. Like that is revolutionary, to go from being embarrassed to not only sharing it with your friends, but literally sharing it public. For Snoop Dogg to like post that he's like stressed about his hair loss and ED is like, it's just like, just think about how revolutionary that was. They, as a result, like they had to spend a lot of money on branding and getting it totally right, because that was the customer acquisition strategy and brand that they chose. Like Snowflake, like their product is like, their product is their defensibility. Like, you know, now they spend money on marketing, but like, who cares what their marketing was on day one, you know? Like, I don't think they were only engineers for the first like 5 years of the business. I mean, that's exaggerating a little bit, but like that was their core competency. And so I think it really depends on the company you're building. And then to your question on the domain specifically, like, I don't think you need x.com. I would venture to say most companies we meet don't have companyname.com. It's like some variation or some other URL. HIMS is still to this day for HIMS.com, right? They don't have HIMS.com, and that's okay. People know how to find them. So, you know, I think it's going to be a strategic decision over time of whether it's worth it, whether it's possible, and whether it's worth the investment, and then the transition to you know, buy that dominant domain. I would say, like, it's pretty cool to have .so websites these days. I meet tons of companies that have .so. I think it's pretty cool. So, you know, I think things are changing versus like 5 or 10 years ago. Is my take, my personal take.
Love that.
Hi, Medha. Thanks for the time. Part of the jobs I think we have to do is to hire people whose domain expertise is different to the ones that we have. And I know how kind of hiring is super important. I think you guys kind of mentioned that as well. Kind of any top advice for hiring people where you just don't have any idea really what they're doing. You know what they'll do for the business, but not necessarily a domain expert in it.
Awesome. That's a great question. Do you mind just introducing yourself as well? So yeah.
Cool. So I'm Zweli Mfundisi. I'm the CEO and co-founder of Empowered Homes. Yeah.
And are you a current student?
Oh, I'm just graduated GSB at Stanford, and my co-founder is recently graduated from Harvard, the Kennedy School.
Awesome. Congrats on graduating. Must have been a weird time.
Zoom graduate. Zoom. I actually haven't technically graduated, so long story. But
your question was around how to hire well.
Hire well, especially in functions that you aren't an expert in.
Yeah, it's a really good question. I think so. If I think about the funnel of hiring someone, it's a sales funnel, right? It's first you have to identify who you need. You have to identify the profile. Then you have to fill your funnel with candidates that fit that profile. Then you have to effectively interview them to figure out who would be a good fit. Then you have to sell them. Whoever you identify, you have to sell to get them, to convince them to join, right? And then there's the post-sales process, which is like ensuring that they're successful at your company. So if I think about every portion of that funnel, I think there's different types of expertise that's required, but you have to do all of those things to end up at the result that you want, right? Which is like, you want someone amazing to be joining your company. I think building the profile, I think there's a couple ways to do that. I think leveraging your investors to the extent that you have them. You know, we have helped a lot of our companies hire a lot. So we probably have a talent person or like job descriptions that we can leverage and people we can leverage. I think the other thing that's really valuable is advisors. Like, I think advisors are underrated, but so helpful, especially in the areas that founders feel like are their blind spots. Because you only need, if they're truly an expert, you only need a couple hours of their time a month to get a ton of value. And one of the best ways they can add value is for them to help you identify those people, either in their networks or part of the interview process, to identify, or give you the like criteria, how you should think about what the right fit should look like. And then I think it's like, there are a lot of best practices online about how to interview well and like identify truly who's going to be best fit versus like looking at a resume and like getting carried away by the person's profile and like envisioning that they would be good and letting that color the actual interview process. And then the sales process is the sales process. You know, you got to convince them to believe that your vision and leveraging just you or your team, you and your team and your advisors and your investors, convincing them that this is the right step for them and that there's a big company to be built on the other side and an interesting role for them to fill. And then there's the post-sales process. There's a lot of content online about how to kind of onboard and ensure some early employees are successful. Does that answer your question?
Yeah, it does. Thanks. Yeah.
Cool.
Great. I think we're starting to run out of time. So does anyone have any last questions before we sign off?
If there are a couple minutes left, I have a question, but anyone else can feel free to go ahead of me. But I'm curious, as an early stage investor or an early investor, do you necessarily go into assessing companies as potentially becoming unicorns, selling off for $1 billion, being acquired, going public, whatever it might be? Or do you ever approach it with the mindset of maybe they'll be acquired for $500,000? Like what metrics are you using to assess the potential of companies, and do they have to hit a certain benchmark in terms of potential?
Yeah, it's a really good question. I think the answer is different for different investors. Especially, not all investors are the same, right? All of our funds are different sizes. And so a great return that we're looking for is really varies. And what I tell entrepreneurs all the time is like, there are amazing companies to be built and amazing like outcomes for founders that just don't make sense for Redpoint based on what we need to do to return the fund, like to have the returns of the fund that we need, right? So for example, at Redpoint, to answer your question specifically, our fund is $400 million today. We assume, right, given how early we're investing, we invest seed through Series B, that the failure rate is going to be pretty high for our companies. And that's okay. But that means that the couple companies that are huge need to be really huge, right? For that to happen. And so what we have to do, the case that we make internally is, what is the case for this company to return half to ideally the entire fund in a success scenario? So if this goes well, based on the ownership that we have when we invest, and then over time as that changes, do we think that this company has the potential to return $400 million to the fund? Right, and that's how we think about whether an investment makes sense for us or not. We have to paint that case. Now, that implies a multi-billion dollar exit, right? But I'll give you the example of, if you were to build a $50 million business, value business, and sell it to whoever, you know, like sell it to Google, and you owned 10% of that business when you sold it, that's $10 million to you. That's like, I don't know about you, I don't know your personal situation, but like, I would just die of happiness if someone were to hand me $10 million tomorrow, right? Especially if it was like for a couple of years of, you know, if I'd been operating the business for a couple of years or even for like many years, that would be incredible.
Right.
For Redpoint, that would not be a good outcome, right? Because we assume most of our companies are not going to succeed, because that's just what happens no matter how hard our founders try and our partnership. And there's going to be a couple of companies that are huge. And so, you know, while that would be a fine outcome for Redpoint, if that was the best outcome that we were hoping for, that wouldn't make sense for our fund. But that's still an amazing outcome for the founder. You know, personally, I would be super happy about an outcome like that. So I think, or a windfall like that, I guess, is more accurate versus an outcome like that. So I think I give that example to say, like, there are plenty of like highly successful outcomes in a business, just not all of them make sense for venture.
Makes a lot of sense. Thanks so much for that.
Yeah, for sure.
Great. I think we will end this workshop / Q&A session here then. Thanks so much, everyone, for bringing your great questions, your experiences. And thank you, Medha, for joining us for this hour and really sharing your advice and expertise with us all. I know we've all learned so much in the past hour. So thanks again, and hope to see everyone at the next couple of sessions for the bootcamp weekend.
Yeah, it was great to meet you all. And if I can do anything to be helpful, just shoot me a note. I'm Medha@redpoint.com. All right.
Thank you
Bye.
both.
Thank you.
Take care, everyone.
Thank you.